Okay, chapter 5, we change gears a little bit. It's still the same as far as, we're still doing accounting, debit still equal credit, or debit still have to equal credits. We still have the same 5 major types of accounts. Our big change comes in the fact that we are moving from a service business to a merchandising business. Now, a service business is a company that goes out and performs a service of some kind and produces what we would call an intangible product. So a CPA firm, a law firm, a doctor's office, a vet clinic, an IT company that performs IT services. Those are all service businesses. What we dealt with in the first 4 chapters was a service business. So our financial statement, our income statement specifically, looked kind of like this here that you can see. We had our fees earned, which was our revenues, minus our expenses, which gave us our net income. Now we're going to deal with a merchandising business. So a merchandising business is a little different because these are companies that buy things and then resell them. They don't manufacture them, they don't make them, they buy them and resell them. So a lot of very large companies do this. You'd be talking about your Walmarts, your Targets, Amazon, those types of companies that buy things from other people that manufacture them and then they sell them to the general public. Now this leads to a difference in our financial statements and leads to a few new terms that we need to learn too. So number 1, at the top of our financial statement, it's still a revenue account. It's still revenue minus expenses. We didn't change the game completely here. We just changed, a little bit of terminology. Our revenues are simply called sales because that's what a merchandising business does. They sell things that they bought from someone else. So sales is our revenue account. So it's equivalent to our fees earned. It's just a different type of business. So sales is revenue. Label that here, revenue account. Next, we take our cost of goods sold out. And our cost of goods sold is a new account we haven't used before, but it is very similar and it really is an expense account because what this account represents is what did I spend on the goods that I sold. So how much did I buy that product for in the first place, and if there were any other costs going into that product, that would be included in there too. But generally, we're talking about whatever we spent on it. So if I bought something for $10 and sold it for $12, my sales would be 12, my cost of goods sold would be 10. That would also mean that I could find my gross profit. Gross profit is sales minus cost of goods sold. That's the next line on my financial statement. This would be my income statement. Right here. So my income statement, and I've got my sales minus cost of goods sold, which equals my gross profit. My gross profit is just the margin that I make simply straight from what I sold it for versus what I bought it for. There are a lot of other expenses that go into merchandising business. So, just because I bought that item for $12 and sold it for $10 doesn't mean that I made, $2 worth of operating income. I had to pay for my building. I had to pay for my employees. I had to pay for all my other operating expenses. We just separate it out and do it kind of in a 2-step process. So we take sales minus cost of goods sold, which gives me my gross profit. And then we would take out our operating expenses in order to come down to our operating income, which is real similar to my net income. So it just adds another layer to this and kind of shows you a difference on how we're going to have to report this. The other couple of pieces of vocabulary here at the beginning of the chapter that are important is inventory, or could be called merchandise inventory. Inventory is an asset. Inventory is something that I own, but it is also something that becomes a cost when I actually sell it. So when I buy the inventory in the first place, it's an asset and it comes in and it's an asset called inventory or merchandise inventory, whichever. And then once I sell it, assuming it's that type of inventory, it becomes cost of goods sold. So my cost of goods sold shifts from my inventory, the asset itself, into an expense called the cost of goods sold. And that's it for this video. I know it's short, but I'm just introducing you to merchandising business at this point. So we'll continue with merchandise transactions in the next video.